Welcome to Objective 3 in Unit 5 of Accounting 3310. In this unit, we'll study the first of our methods of tracking inventory, called first in, first out. Inventory is an estimated number. Even if a company were to use specific identification method to determine the unique item sold, there would still be judgment involved in selecting the one item for a customer from among all such items. The most common inventory method, which also matches the most common inventory management strategy, is called FIFO, which stands for first in, first out. How is inventory tracked with the first in, first out method? Our objective here is that students will be able to use the first in, first out flow system to value inventory and cost of goods sold. Let's take a basic example so that we have something specific to talk about when we talk about the estimation method. The problem behind valuing inventory is that when there's a variety of prices for different batches of the same goods, how do we decide which batches were sold and which are still in ending inventory? FIFO provides a principle to use that the sales are from the oldest purchases, so what remains in ending inventory are the most recent purchases. Here's our example. The beginning inventory is 1,000 units at $6 each, and there were 3 purchases of this same product during the year, each of $1,000 at successively higher dollar values per unit. The sales took place in January, February, April, and December. The cost of items sold are transferred from the asset account of inventory to the expense account of cost of goods sold, assuming that the oldest purchases were sold first and the newest purchases remain in ending inventory. This method closely matches the most common inventory management strategies, although it's still just an estimate used in the place of tracking actual exchanges. The FIFO is a commonly used inventory method because of these advantages. There's a low information requirement. Only the most recent information is needed, and we don't have to keep very much historic information. It's also computationally simple, and it's difficult to manipulate because any purchase of inventory impacts net income at some time in the future, perhaps next year. The FIFO valuation of inventory is near to current value, but current income is matched with older costs, resulting in higher incomes, especially when prices are rising. When there are generally declining prices, FIFO results in a lower income than LIFO because lower prices are in ending inventory. Therefore, many technology companies that experience declining prices in components find a tax advantage in FIFO inventory method, lower taxes because they have lower income. FIFO is also used by industries that regularly record inventory impairment, for example, publishing industry, because the IRS doesn't allow impairment to be taken when LIFO is used. The LIFO procedure is this. First, gather information about the inventory layers in beginning inventory and current year purchases, including the units sold and the units remaining in inventory. Beginning inventory is typically a small number of layers. Allocate those layers or portions of layers to cost of goods sold, beginning with beginning inventory and the earliest purchases. Allocate the layers or portions of layers to ending inventory, beginning with the most recent purchases. Periodic system and perpetual system have identical results in a FIFO inventory method system, but the perpetual system keeps accurate inventory cost of goods sold throughout the period, while the periodic system only has a value for cost of goods sold at the end of the period. When we gather the information about layers, we find that we have a total of 4,000 units in layers with each of these individual costs for a total cost of $30,000. The sales were 2,500 units and the ending inventory is 1,500 units. When we allocate the layers to cost of goods sold, beginning with beginning inventory and the earliest purchases, we're going to put the 1,000 at $6, the 1,000 at $7, and 500 out of the ones that were purchased at $8 into cost of goods sold. This means what's left for ending inventory are the most recent purchases, 1,000 at $9 and 500 at $8. This is 1,500 units at a total cost of $13,000. There's no difference in the value of inventory or cost of goods sold between the periodic and the perpetual systems when using FIFO, because on an ongoing basis or at the end of the period, we're always working with the most recent purchases ending up in ending inventory. This is the end of your introduction to first in, first out inventory. In our next objective, we'll look at the other ways that we can estimate inventory.